What if the money sitting in your bank account isn't actually sitting there? You deposit $10,000. You see $10,000 on your screen. It feels safe. It feels like your money is waiting for you. But then someone tells you the bank can lend your $10,000 out again and again, potentially creating $90,000 of new money. Sounds crazy. And for decades, simplified explanations of fractional reserve banking used exactly this kind of example. But here's the problem. That's not actually how modern American banking works. The truth is stranger. And once you understand it, you'll realize that when you deposit money into a bank, something much bigger is happening than simply putting cash into a digital vault. The $10,000 example. Imagine you deposit $10,000 into a bank. The old textbook explanation might say, the bank keeps 10%. That's $1,000. Then it lends out $9,000. That $9,000 gets deposited into another bank. That bank keeps 10% and lends $8,100. Then another bank lends $7,290. And so on. Eventually, the original $10,000 could support roughly $100,000 in deposits. That's where the famous money multiplier idea comes from, and that's probably where you've heard claims that banks can loan your money 9 times. It sounds like banks are taking your dollars and magically multiplying them. But modern banking isn't that simple. The big change nobody talks about. In the United States, the Federal Reserve eliminated reserve requirements for transaction accounts effective March 26, 2020. The reserve requirement ratio was reduced to 0% for all depository institutions. So today, saying banks must keep 10% of your deposit and can lend the other 90% is simply not an accurate description of the current U.S. banking system. There is no current 10% reserve rule forcing banks to follow the old textbook sequence. But that doesn't mean banks can create unlimited money. Far from it. So how do banks actually create money? Here's the part that sounds almost unbelievable. When a bank approves a loan, it generally doesn't need to physically take existing cash from one customer's account and hand it to another. Instead, the bank creates a new deposit when it makes the loan. Imagine you apply for a $300,000 mortgage. The bank approves you. The bank records an asset, your $300,000 loan, and a liability, a $300,000 deposit in your account. Suddenly, your bank account contains $300,000 that wasn't sitting there before. You can use that deposit to buy a house. The seller receives the money. The seller deposits it. And the banking system continues processing the payments. This is one of the fundamental mechanisms through which commercial bank lending creates deposits. And that's much more interesting than the simple lend the same $9 times story. Your deposit is not a box of cash. Here's the mental model you need to forget. You might imagine that your bank has a giant vault containing your exact $10,000. It doesn't. Your deposit is a bank liability. The bank owes you that amount. At the same time, the bank owns assets, such as loans and securities, that generate income. That's how banking works. When you deposit $10,000, the bank records, plus $10,000 deposit liability and receives corresponding assets, such as reserves or cash, depending on the transaction. Then the bank can use its balance sheet to make loans and conduct other financial activities within the limits imposed by regulation, capital, liquidity, risk management, and funding. Your money isn't sitting in a little envelope with your name on it. It's part of a much larger financial system. But can banks create unlimited money? Absolutely not. This is where internet explanations often go wrong. If banks could create unlimited money simply by typing numbers into accounts, every bank would immediately become the richest institution on earth. They can't. Banks face capital requirements, they face liquidity requirements, they need funding, they need credit-worthy borrowers, they need to manage the risk that borrowers won't repay, and banks have to settle payments with other banks using reserves and other forms of settlement assets. So the real limitation isn't simply how much cash is sitting in the vault. It's much broader. The bank has to ask, can we safely make this loan? Do we have enough capital? Can we manage the liquidity? Will the borrower repay? Is the loan profitable after its risks and costs? Those constraints matter enormously. What happens when you spend the loan? Let's go back to that $300,000 mortgage. The bank creates the deposit. You use it to buy a house. The seller receives the money. But suppose the seller banks somewhere else. Now the two banks have to settle the payment. This is where reserves become important. Banks maintain reserve balances at the Federal Reserve, and those balances are used in the financial system for settlement. So while reserve requirements are currently zero, reserves themselves still matter. This is one reason the old story is misleading. Banks don't simply create unlimited deposits and forget about the rest of the banking system. system. The payments have to clear. The balance sheets have to work. The bank has to remain solvent and liquid. So where did the 9 times come from? The 9 times idea is essentially a simplified mathematical illustration based on a 10% reserve ratio. If a bank had to keep 10% in reserves, the textbook deposit multiplier would be 1 divided by 0.10 equals 10. So an initial $10,000 reserve could theoretically support up to $100,000 of deposits under extremely simplified assumptions. The difference between the original $10,000 and the theoretical $100,000 is sometimes described as roughly 9 times additional deposits. But real banking doesn't operate as a mechanical chain where $10,000 to $9,000 to $8,100 to $7,290 forever. The actual relationship between reserves, deposits, lending, and money creation is much more complicated. And in today's US system, the reserve requirement is 0 anyway. The strange part, your loan creates money. Here's perhaps the most fascinating part. When you borrow money from a bank, the bank doesn't necessarily need someone else to deposit exactly that amount first. The act of lending can create a new deposit. That's why bank lending has such an important role in the money supply. If banks become more willing to lend and households and businesses borrow more, deposits can expand. If banks tighten lending and borrowers pay down debt, deposits can contract. So credit isn't just something that happens inside the economy. It can change the amount of bank-created money circulating through the economy, and that has enormous consequences. This is why interest rates matter. Now the Federal Reserve enters the story. When interest rates rise, borrowing generally becomes more expensive. A company might decide, we're not building that factory anymore. A family might decide, we're not buying that house yet. A business might decide, we'll wait before taking out that loan. Credit demand can change. When rates fall, borrowing can become more attractive. That's one reason monetary policy has such a powerful influence on economic activity. The banking system acts as a transmission mechanism between financial conditions and the real economy. And that means your mortgage, your car loan, your business loan, and your credit card balance are all connected to a much larger system. The real secret. So the next time someone tells you, banks take your money and loan it out 9 times. Don't simply believe it, don't dismiss it either. Ask a better question. How does modern banking actually create money? Because the answer is much more fascinating. Banks don't need 9 copies of your dollar. They operate balance sheets. They create deposits through lending. They settle payments through the banking system. They manage capital and liquidity, and they operate under a huge network of regulations and constraints. The famous fractional reserve story is therefore best understood as a historical textbook model, not a description of how modern US. Banks mechanically multiply deposits 9 or 10 times. And perhaps the biggest lesson is this: money isn't nearly as simple as it looks. The number on your banking app isn't a pile of physical dollars waiting in a vault. It's a claim on a financial institution, inside a system built on lending, payments, confidence, regulation, and credit. And once you understand that, you'll never look at the number in your bank account quite the same way again. If this video changed the way you think about money and banking, hit like, subscribe, and share it with someone who still believes banks simply lend out the same dollars over and over again.